Hey there, Jim Brees here from Green Growth CPAs, and today we're going to talk about another tax court ruling that could impact your cannabis business. Now, we talk about 280E a lot around here and how it impacts cannabis businesses in a negative way, really piling on those taxes. Now, businesses get audited all the time. What kind of defenses do they use, and how do those defenses result at the end of the case, and how do things really shake out for the business? We'll explore all that and more in this video. Now, if you have any questions about developing a tax strategy for your cannabis-based business, then please reach out to us via our website at greengrowthcpas.com or give us a call at 800-674-9050. Let's hop right into the presentation.
So again, today's topic is a 280E case study where we dissect the case of Northern California Small Business Assistance Incorporated versus the Commissioner of the Internal Revenue Service. My name is Jim Brees, the Chief Marketing Officer here at Green Growth CPAs. And as you know, taxes in the cannabis industry can get very nuanced and very complicated very quickly. You'll hear about a lot of different cases and how they shook out in the end, and there's a lot of common threads that I want to dissect and talk about in this presentation. But before we do, I need to let you know that the information contained in this presentation is for guidance purposes only and not as professional, legal, or tax advice. Further, it does not give any personalized legal, tax, investment, or any business advice in general. So with that out of the way, let's review what we'll cover today. So first, we're going to talk about what happened in this specific case. Then we'll discuss some main takeaways and then things to remember and incorporate into your cannabis business going forward. So let's look at some facts of this case and what happened in the end. So Northern California Small Business Assistance Incorporated is a California corporation that operated a legal medical cannabis dispensary. Now, they claimed $1.5 million in ordinary and necessary business expenses on their 2012 tax return, right? Things like the marketing, rent, things like that, right? Just regular ordinary business expenses. Now, the IRS disallowed the company's tax deductions under Section 280E. Now, in court, the cannabis business argued their case in 3 points of why it doesn't apply to them. Well, why 280E doesn't apply to them. Now, point number one, they say that the 280E regulation violates the 8th Amendment, which states that excessive bail should not be required, nor excessive fines imposed, nor cruel and unusual punishments inflicted. Their second point was that if the 280E regulation is constitutional, then it only prohibits ordinary and necessary business deductions under Section 162 of the tax code and does not apply to any other sections of the Internal Revenue Code. And their third point, they say that their business was operating legally under state law, therefore it is not subject to 280E. Remember, I said state law in that third point. That is a very important nuance to their argument. Now, unfortunately, for the business, the court disagreed with all the business arguments in total. There was not one bit that they said, oh, you're kind of right. They just said no to all of this. Now, the court concluded that 280E does not violate the Constitution or the 8th Amendment, and also held that 280E doesn't apply to just general business expenses from Section 162 of the tax code, but actually applies to bar all deductions in this case. Now, lastly, they said if you're a state licensed cannabis operator, you're still trafficking cannabis in the eyes of the federal law. It's a Schedule I controlled substance, and 280E applies to Schedule I controlled substances. The Internal Revenue Service is a federal organization, and we're doing federal returns here. So what the court said is that we are constrained by the law, and Congress has not carved out an exception in Section 280E for businesses that operate lawfully under state law. Until then, the taxpayer, which is the business in this case, is not entitled to deduct expenses incurred in the operation of a drug-related business. So essentially what they're saying is no matter if you're approved by the state or your city, you are still operating a business that traffics a Schedule I controlled substance, and 280E will apply to you. So that was the facts of the case and how it shook out for the business. Now let's talk about the main takeaways from this case as a cannabis business, things you need to really understand. This verdict follows the precedent set in the Harborside versus the IRS case. And in that case, just one of the defenses that Harborside uses that since 280E was passed prior to the legalization of cannabis at the state level, then 280E shouldn't apply to cannabis businesses. Also in Harborside, they tried to get very creative with their cost of goods sold, and it really backfired for them. You can go look into that case. We've got a blog post on that. Just Google Harborside versus the IRS, Green Growth CPAs, and you'll be able to read our breakdown of that case in total. But what you see in this case here that we're talking about, the Northern California Small Business Business Assistance Incorporated case is that arguments against 280E using the 8th Amendment always fail. Taxes are not considered penalties or excessive fines. Though yes, the taxes might seem like they're excessively punishing to the cannabis industry, but legal experts argue that the main goal of taxation has always been to raise revenue to fund the government. It's called the IRS, the Internal Revenue Service. So what you're learning is that using taxes as an instrument of social policy does not transform taxes into punishment for the disfavored activity, which is trafficking cannabis, right? Think of tax-exempt organizations. Congress wants to encourage and support certain social, useful, organized activities, and so entirely exempts from taxation the organizations that foster that purpose. That does not mean that taxing other entities is punishing them. So not only are the courts not interested in hearing any arguments against the constitutionality of 280E, but if you lose the case against the IRS, saying that, hey, it's unconstitutional, they will bring the full power of 280E against your cannabis business. Or if you try to get too creative with COGS, they will bring the full power of 280E against your cannabis operation. Now, let me really break this down for you. You've probably seen a lot of videos, but you've not read the code, the Internal Revenue Code 280E. So in the written opinion from this case, the court writes, the first line of section 280E, no deduction or credit shall be allowed. And they bolded no deduction or credit. So there was emphasis added here. And further, they said Congress could not have been clearer in drafting this section of the code. So what you're getting at is that there's little room for negotiation in this statement. No deduction or credit shall be allowed. Now, yes, it's true that one judge in this case argued that income must take into account the basis and cost of goods sold. Now, however, when all said and done in this case, all the deductions were disallowed for this cannabis business. So NCBSA was taxed to the fullest extent of the law, and there was penalties, fines, and interest added to it. The court even went as far to rule that NCBSA could not apply tax payments as credits. Things they paid out as taxes that they had to, shell out. They couldn't even deduct those. So with razor thin margins in the cannabis industry, can you really afford to pay 20 or 30% tax on your top line and stay in business? Probably not. So you really got to think about this and be very thoughtful when you have a tax strategy. Are you being very aggressive, or are you trying to stay conservative and really play nice with the government? One big thing I don't want you to miss here is that taxes need to be planned for in a worst case scenario, not a let's hope this doesn't come to bite us in the butt later kind of strategy. As a cannabis business, always put money aside every day for taxes as you empty tills or take in revenue from products that you grow or products that you manufacture or products that you deliver. Please put aside at least 25 to 30% of that top line cash in a separate safe or a separate account just for taxes. Now, if you have too much saved when it comes time to file, then you now have some cash on hand to play with and invest in your business. If you're short, you won't be as short, and if you are right where you need to be, then you've established a positive business habit and a solid standard operating procedure for your cannabis business to hedge against the risk of big tax bills that can crush you in the moment. Now, you may think that it's a joke when I say this, but I would beg to say that 50 to 60% of cannabis businesses that we help dissolve are not closing because they didn't find a product market fit. There's a lot of product gaps where you can, all right, we got to put this here and we're going to make good money. These people are making great money, but they just couldn't keep up with their taxes, and the penalties and the interest and the fines killed their cash reserves on hand and put them into further debt that they couldn't get up from under. It's really important. This is the underbelly of cannabis businesses. You don't hear about this. When people fail, they don't want to talk about their failures. And I'm bringing to light here for you the things that we see is that a lot of businesses are failing because they're not preparing for taxes. Personal taxes, you may think, oh, I've heard stories that people don't file for 5 years and they didn't go to jail, or they just had to pay some fines and a little bit of fines. The government is making an example of cannabis businesses, and I'll get to that a little bit further when we discuss right now the things to remember from this case. So there's some good news unrelated to the verdict of this case. So in November 2019, California signed Assembly Bill 37 into law. Now, essentially, this eliminates the Section 280E restriction for licensed personal income tax cannabis businesses. It means that these cannabis businesses can now deduct ordinary and necessary business expenses on their California income tax return. Well, it's not really a huge win. It's something, but your state taxes are nowhere near what your federal taxes are. So this doesn't impact federal taxes. This is just at the state level. And as this case has demonstrated, it doesn't matter if you run a state licensed legal cannabis business. Cannabis is still a Schedule I controlled substance, and your business is still subject to IRC 280E. The court case reaffirms this stance very heavily. So I really want you to understand that no matter if you're state licensed or not, you are still subject to 280E. Lastly, in its conclusion, the court stated that it is limited in its power based on the law. The proper avenue to redress this business's grievances is through Congress, because changing tax laws is a legislative process that must originate with Congress. The fight to allow tax deductions for dispensaries or any other cannabis business operating legally under the state law is a legislative fight, not a judicial fight. So bottom line, here's what you really need to remember and what you really need to, put this lens on your camera so you can see your business in this way. Cash crimes are the new drug crimes. The government really doesn't care about the cannabis product all that much anymore. Yes, they are still seizing product and things of that nature, but they just want their green rush of tax revenue that they promised their constituents all along the campaign trail. One of the big things that they were touting as they're legalizing cannabis is it's going to, solve all of our problems. We're going to fix the roads and repair the schools and all the things that are wrong with our state or wrong with our government at a federal or county or city level is going to be remedied by this big booming cash cow of a business called the cannabis industry. When you really look back at some of the campaign promises, it was about the tax revenue. So what you need to do is get professional tax advice that is backed by experience and tax court rulings. Do not try to bypass or bend the laws in your favor by trying some new and creative tax strategy. A CPA that has deep experience in the cannabis industry can guide you through the many nuances in cannabis tax law that a local CPA may not have experience in navigating, or just doesn't even want to touch the project at all. We hear a lot of clients that come to us and say, hey, my local CPA will not even touch cannabis businesses because it's so detailed and they don't know if they're really going to do a good job or not. So you need to understand that cannabis is a team sport. You need to have good CPAs. You need to have good lawyers. You need to have good operations managers. You need to have good frontline people and backhouse people. There's a lot of people that go into making a cannabis business successful. Now, on the tax side of things, if they do go south and you do get audited for whatever reason, because they can be random audits, they can be targeted audits, the information for cannabis businesses is all out public on the government websites. The IRS could easily just go to bcc.ca.gov and just export a list of all the dispensaries and just hit them all up. So if you do get audited, don't let your lawyer or CPA gas you up thinking you're going to change the inertia of a tax code, the 280E tax code, with some creative solution or argument or some industry pioneering court case. Really think about this, okay? You're going toe-to-toe with the federal government and you're essentially trying to take money out of their pocket. Do you really think that you're going to come out in a better position on the other side of this case, right? Be thoughtful when you embark on a radical audit defense and make sure you know what you're trying to get out of it. So are you looking for recognition or fame for being the first to defeat the IRS at their own game? If so, good luck. I'd love to know how that shakes out for you. Or are you looking to get out of the case quickly with the least damage to your pocketbook and allow you to continue building a valuable cannabis business? That's easier to do if you play nice with the IRS. And it's even easier if you work with a CPA ahead of time, having all of your documentation in place. So when you get that audit letter, you can reconstruct your documentation and your financial obligations and all the things that happen financially within your business to just breeze through that. You can tell the agent that's auditing your case, hey, here's all the financial reconstruction documents, work with my CPA. Give the power of attorney, power of authority to the CPA to deal with the IRS. You don't want to do this alone and by yourself. You want to have, again, a team to help you through this IRS audit defense. So I know we beat the drum here about 280E a lot, but I really want you to understand the impact it can have on your business if you do not take it seriously. And if you're looking to develop a robust and effective tax strategy for your cannabis company, then please reach out to Green Growth CPAs via our website at greengrowthcpas.com or give us a call at 800-674-9050. We've helped hundreds of cannabis businesses from the small $100,000 operator, running their business, all the way up to the big, large public companies making $50 to $100 million a year. We've seen it all. We're able to handle all the different verticals in the cannabis industry, so we've got your back and we've got your best interest at mind. So again, if you're looking for an effective tax strategy for your cannabis company, please reach out to us at greengrowthcpas.com or give us a call at 800-674-9050. Have a great day, and we'll talk to you soon.